Welcome to the third video in this risk management tutorial series. In this video, we will be discussing portfolio diversification as a means of managing risk by distributing it based on different criteria. Portfolio diversification is the technique of allocating your account balance or investments across different asset classes. In our context here, it would imply allocating your account balance in trading different currencies instead of simply sticking to trading one currency pair. This technique involves taking positions on different currencies based on various factors, some of which are as follows. First being the correlations of different currencies with each other. Correlation, as the name suggests, is the behavior of one currency relative to another. We will discuss more on correlations later in this tutorial. Then, apart from simply diversifying in terms of currency pairs traded, one should also diversify in terms of the trading strategies used, such as going long and short for a basket of currencies against another. This will again be based on the correlations of the currencies selected in that given basket of currencies chosen to trade. And finally, diversification in terms of trading frequencies, that is, the intended time frame for holding on to those trade positions on different currency pairs. For instance, you might be aiming at a weekly target for a certain currency pair, hence would hold on to that trade position on that currency over a week. However, for a certain currency pair, you might have an intraday target, or a target maybe just over a few hours. Therefore, there are different ways in which one can diversify their portfolio to manage their risks better. We begin with analyzing the benefits of diversifying your portfolio of currencies. Portfolio diversification helps to hedge the risk and thus protect the account equity from being completely wiped out. It neutralizes the loss of one trade with the gains of another. For instance, let's say you have a long position on one lot for euro-dollar and one long position on dollar-yen. If now the euro-dollar starts to slide towards lower price levels, but the dollar-yen rallies, then the loss incurred on the long euro-dollar position will be offset or neutralized by the gain on dollar-yen. So this way, we hedged our risk on long euro-dollar by going long on the dollar-yen simultaneously. It is important to note here that the rule of prudent capital management comes into play at this stage, where one should learn to book his loss on a losing trade and let the profits run. That is, not to become a victim of the disposition effect we discussed in our previous video. This way, portfolio diversification helps increase the probability for long-term trading success and thus help in surviving the markets. We now will discuss the various ways of diversifying the portfolio, starting with the use of correlations. Correlation, as discussed, is the behavior of one currency relative to another. Different asset classes or currencies in our case are said to be either positively or negatively correlated with one another, or they may have zero correlation with each other. The coefficient of correlation is the measure of the correlation of one instrument, the currencies in our case, with another. Positively correlated currencies tend to move in tandem with one another. So if one rises in value, so will the other. Negatively correlated instruments, on the other hand, move in opposite directions from one another. So if one rises in value, the other falls. Diversification should be done among negatively correlated asset classes or negatively correlated currencies in our case. Therefore, one should allocate their account equity among negatively correlated currency pairs. The coefficient of correlation for a negatively correlated currency pairs is negative, These coefficients of correlation are often available in various websites that publish this data about different currency pairs. So to use these currency pairs, if you go long on one of the negatively correlated currency, then you need to go short on the other and divide the total risk percentage that you're willing to risk among these two currencies. So considering that you don't want to risk more than 2% of your total equity, each currency pair can get 1% and the risk gets divided. Consider the example of euro-dollar and euro-yen. Assuming you give equal weighting to each of the currency pairs, these currency pairs are generally found to exhibit negative correlation with each other. So if one rises in value, the other falls. Thus, we would go long one and short the other. For an account equity of 10,000 and the maximum risk percentage of 2%, we should be able to allocate 1% risk for each of these pairs. Therefore, I can afford to lose a maximum of $100, that is 1% of 10,000, which comes out to be 100 pips on 0.10 lots on my long position on the euro dollar. And similarly, $100, that is equal to 10,000 Japanese yen, which comes out to be 100 pips on 0.10 lots for the euro-yen pair, since it's 3 decimal pricing, is what I can afford to lose by going short on euro-yen. This is better than risking $200 on just one trade, either long euro-dollar or short the euro-yen. Assuming that both euro-dollar and euro-yen fall in value, then the loss on the long position for the euro-dollar will be offset by the profit on the short euro-yen. This way, we protect ourselves in losing all the equity with only one position of long euro-dollar. However, this also means that you need to let go of the additional profit that you could have attained on being just short on the euro-yen. This is what is called the opportunity cost of diversification. Next, we analyze the use of different trade strategies as a means of diversifying. One should try to allocate the percentage of your equity into different trade strategies for trading different currencies. This should be aimed at reducing the overall drawdown percentage of your account. In order to do so, one should begin by analyzing the behavior of the currency pair to identify the type of price movement. Price movements can be broadly classified as range-bound. This is when the price continues to hover between a given high and low for a considerable time. Then, secondly, it can be classified as a trending price move. This could be over a long or a short time frame, depending upon your preference. A currency pair could be trending over a longer time frame, say over a weekly time frame, but could be actually falling down on an intraday basis. This is where the third strategy of scalping counter trend comes into play. Scalping counter trend involves taking trade positions over a very short time frame in the direction opposite to the broader trend. And finally, we have the breakout as another trading strategy, mostly used by chartists who look for a breakout of a technical chart pattern as a trade signal to initiate trade positions. So one should try to take trade positions in different currency pairs based on the behavior of their price movement, instead of sticking on to just one trade strategy. Consider, for example, for an account with an account equity of $10,000, the maximum risk that I'm willing to take is 2% of the total equity. I notice that cable, that is the pound against the US dollar, is moving within a particular price range. So I decide to allocate 0.5% of my total account equity for the cable trades. This means I can lose a maximum of $50 on trading pound yen on a 0.10 lot size, which comes out to be 50 pips. So I need to monitor my trades on pound dollar so that the total loss on all of them does not exceed 50 pips or $50. At the same time, I notice a breakout of a technical chart pattern for euro-dollar. So I allocate another 1% of my total account equity at the start of the trading for euro-dollar trades. That comes out to be 100 US dollars. This means I can lose a maximum of 100 pips on 0.10 lot size on trading euro-dollar. So now I need to monitor my trades on euro-dollar so that the loss on all of them does not exceed 100 pips or $100. In total, I'm risking 150 US dollars, 50 on pound-dollar trades and 100 on the euro-dollar trades, which is less than the 2% which I'm willing to risk at a given point of time. Let's consider an example in which we use 3 types of trading strategies for 3 different currency pairs. So at the start of the trading, when the account balance is equal to account equity, which is 10,000 US dollars, I decide to do range trading for the pound dollar on 0.10 lot size, trade a breakout of the technical pattern for euro dollar, again on the same 0.10 lot size, and decide to do scalping either with the trend or counter trend for the Aussie dollar, again on 0.10 lot size. I keep the risk percentage which I'm willing to risk for each of these currency pairs as 0.5% for pound dollar, 1% for euro dollar, and 0.5% for Aussie dollar. What this means in terms of the absolute amount is that I'm willing to risk 50 US dollars for pound dollar trades, 100 US dollar on euro dollar trades, and 50 US dollars for the Aussie trades. In terms of pips, this comes out to be 50, 100, and 50 pips respectively. The total sum of the amount that I'm willing to risk in absolute terms comes out to be 200 US dollars, which is 2% of my total account equity. Consider that at a given point in time, my pound dollar trade goes against me, while the other 2 continue to remain in profit. If the loss on the pound dollar trade is negative 40, while the gain on euro dollar is 80, and for Aussie is 50, my total account equity, which is the account balance plus minus the floating profit or loss, comes in at 10,090 US dollars. At this level of account equity, at 10,090, we recalculate the amount that we can risk at 0.51 and 0.5% that we decided to allocate for each of the currency pairs. This is given in the table as shown. For pound dollar, I can now risk 50.4 pips, while for euro dollar, I can risk 101 pips, and for Aussie, it's again 50.4. A marginal change from the previous ones. This is because the scale at which we are calculating or trading is very small. Now, since you're losing out on the first trade strategy, you can partially book the loss on the losing trade and initiate a new position to scale up on the winning strategies. So we decide to book 0.05 lots out of the 0.10 open for the cable trades and add this 0.05 lots to the already open 0.10 lots for the euro dollar trade. So now we have a position of 0.05 on pound dollar and a position of 0.15 lots on euro dollar. Aussie dollar position remains unchanged at 0.10. Now, since we've partially booked the loss on cable equal to 20 US dollars, we still have a running loss of $20 on that trade. Assuming a gain on our euro trade position as 30 US dollars and break even for the Aussie dollar, our account balance now is the initial balance, that was 10,000, minus the loss that we have already booked. This comes out to be 9,980 US dollars. And the new account equity is account balance plus the floating profit or loss, which comes out to be 10,120 US dollars. That is the account balance plus 140 US dollars of profit. So by doing so, we've been able to increase our risk appetite while at the same time maintain our risk at 2% of the total equity. Since by reducing the lot size for the pound dollar trade, I've increased the number of pips that I can risk while maintaining the risk percentage at the same 0.5%. As initially on 0.10 lot size, I could only risk about 50 pips on this trade, while now by reducing the lot size, I have increased the pips that I can now risk on this trade, if I continue to hold on to it, to 101 pips. However, please note that by increasing the lot size of your winning trade, that is the euro dollar, we have reduced the number of pips that we are now willing to risk on this trade from 100 to 67.4. So if the trader is confident about his pound dollar trade, he can hold on to it, or rather completely square off his trade and scale up further either his euro dollar or the Aussie dollar trades which are going in favor. He can then either partially book his profits to ensure that he has profits booked, while at the same time increase the number of pips that he can risk by reducing the lot size. So these are some of the ways in which, by managing your portfolio of currencies instead of restricting to one currency pair, you can aim to manage your risk better and also at the same time increase the probability of earning higher returns. Hope this tutorial was of help to you. Thank you again for taking the time to watch this video.